TV18.
Hello and welcome to the CNBC TV18's Mumbai News Center. I'm Sumaira Abidi and you're watching MF Corner. On the show today, we'll connect with Ashish Shanker of Motilal Oswal Private Wealth to understand how an investor should be navigating volatility. And a little later, we'll connect with Tarun Virani of TBNG Capital Advisors to discuss a student's guide to their investments. So first up, let me invite Ashish Shanker, MD and CEO of Motilal Oswal Private Wealth. Hi Ashish, thanks very much for joining in. You know, the present environment is stressful for portfolios, right? But it's not the first time. I mean, the world has lived through the global financial crisis and, you know, so many others, US terrorist attacks and many number of issues in West Asia. Each time we have seen that the market has followed up this shock with a rally. So will it be, you know, same or similar this time around as well? I mean, what I mean to ask is, are we living in a time of great opportunity or great adversity?
Right. First of all, Sumaira, it's always a pleasure to be on your show. Yes, you're right that we've gone through a lot of volatility. Actually, the last 2-3 years have been extremely volatile and we've been hit by one event or the other. However, if you look at the geopolitical events in the last 25 years, generally geopolitical events are opportunities. The reason is that market sells off whenever there is a geopolitical event, and invariably when the event actually gets triggered. So for example, there was a lot of news that there is going to be a geopolitical tension between Russia and Ukraine, but actually the bottom happens when the war starts, and we've seen this across many geopolitical events, right? So clearly, Sumaira, if I were to look back and look at how the markets have behaved in the last few crises and the returns that they have generated 3 years from then, it has always been a strong double-digit return. So my guess is that it won't be too different from now to the next 3 years as well.
Okay, but you know, Ashish, the thing is, when you're living through it, you cannot tell how long the drawdown can last, right? It's, you know, when we do know is, you know, it's only in hindsight, right? So therefore, how does an investor know when is a time for course correction or not? You know, does an investor just stick to their pre-decided asset allocation and only, you know, rebalance regularly?
Yeah, so I'll answer this in two parts, Sumaira. So at least at our end, what we do is we track valuations very closely, and our valuation indicators are quite holistic in the sense that we look at equity indicators as well as the prevailing interest rates. Now, clearly when markets correct, valuations change. So markets this time around, they corrected from an expensive zone to a fair value zone and closer to a cheap zone, right? So clearly it was an opportunity for any investor who wanted to add equity allocations to add it then. Now why I'm saying this helps is because if you look at valuations, right, you can cut out the noise. Otherwise what happens is that you get carried away by the news flow of the day and there are multiple events happening. So if you focus on valuations and if valuations are fair and you're a longer term investor, it doesn't matter. I mean, you should be willing to see a 5% further downtick on your portfolio and put in the money. I always say that it's easier to buy on the downside because there's less competition. Because we've seen whenever the situation eases, you can have very, very sharp pullbacks like the ones we've seen this week. The second way to look at it, Sumaira, is that every investor must have a certain asset allocation plan, right? And typically the way I look at it is there are broadly four asset classes. One is a growth asset class, which is equity. Second is an income asset class, which is predominantly debt. You have liquidity asset class, which is cash, and the fourth is an insurance asset class, which is gold. Now, typically what happens during such events, Sumaira, is that the insurance asset class, which is gold, right, it tends to do very well. So if you look at the last 1 year return of gold, it's 20%. Now, you're not going to benefit if you invest in gold today, right? You ought to have already had gold exposure before the event. So we run a all-weather strategy for a lot of our clients, which has 20% allocation to each of these asset classes, which we rebalance every year. So during such events, what happens is equity sells off. It reduces weight in the portfolio. Gold does well. So the weight of gold goes up. So it gives you a nice window to actually sell gold or fixed income and rebalance into equities.
You raised, you've said something very important, Ashish, is that for your portfolio to win, you should have actually already been invested, right? The problem is that a lot of people come in, when the rally is almost done, because they keep seeing that, oh, it's going up and up and up. But the thing is, you should have already been there to see that kind of upside. But, specifically for equity, how does an investor know when to add on more? I was going through your presentation. I know you have something called the temperature gauge index. Is it something that a retail investor can use as well? Can you explain how to go about it?
Yeah, so it's a very simple indicator, Sumaira, and we've tried to simplify it as much as possible for clients to understand how to allocate money into equities. So we basically have three zones in terms of valuations. We have the cheap zone, we have the fair value zone, and we have the expensive zone, right? The other thing that you also need to know is whether from your strategic allocation, are you underweighted equities, are you okay on equities, or are you overweight on equities, right? So if you superimpose these two things, we've given a simple guide as to how you should go about allocating money into equities. So for example, let's say if you're underweight equity and the markets are in a fair value zone, which they are currently, then you should put 50% of the incremental allocation on day one and stagger the 50% over the next 6 to 12 months, right? So you get a nice average. If you're in the cheap zone and you're underweighted equities, then you should actually put 100% at that point in time. The reason why, Sumaira, we don't advise timing the markets is because the markets stay at the cheap zone or at the very expensive zone, which typically we call the bubble zone, for a very short period of time. I mean, if I add it up, it is only 15% of the time. So it's very difficult to catch those points. So my advice to investors is basically in the cheap zone and the fair value zone, you should be an investor. In the expensive zone, the best you can do is don't put additional money, right? If you feel your allocation to equities has gone way above what you can tolerate as a risk, then you should gradually reduce. So this is also important. People tend to reduce immediately. They tend to sell the entire excess equity allocation. So you should also reduce gradually, because markets can become more irrational and stay irrational longer than you can think of.
Yeah, absolutely. And but what the thing is, right, that even the fear of a notional loss hurts much more than the pleasure that gains provide, right? But for periods like this, right, for an investor, I mean, ideally they have a core portfolio, they have a tactical portfolio, right? Now, considering that periods of volatility can also be periods of great opportunity, how can the tactical portfolio be used in an ideal manner?
Yeah, so look, broadly, most people will have some allocation in their mind to risk asset classes. So an aggressive investor will have 70-80% allocation to equities. But opportunities like these, like I said, markets actually came down to the fair value and closer to the cheap zone after a long time. These are opportunities to even probably increase your risk on the portfolio. Let's say, for example, you are comfortable with 50% equity, but the markets fall and your portfolio comes down to 45%. So maybe instead of increasing it to 50, you can make it 60. And after a year, let's say if markets have recovered, at that point in time, you can readjust. So what happens is these times, these kind of periods, they give you that opportunity to make that little extra money on your portfolio. And that's one way how you can think of these events as an opportunity.
Okay, actually, just one more question. I mean, since we are a mutual fund show, I want to find out if, any particular category of funds are better at navigating volatility. I mean, should you look at, for somebody who cannot stomach volatility, perhaps look at increased exposure to, say, hybrid funds? I mean, is there a logic like to this?
See, if you look at most hybrid funds in the market, they are more equity oriented. Reason being that you get a tax advantage. So actually in this fall, right, hybrid funds have fallen almost as much as equities. I mean, I'm talking about these balanced funds, right?
Yeah.
The balanced advantage funds do help you cushion volatility to some extent, because they do tend to reduce equity exposure when markets are high in terms of valuations. But see, what happens, Sumaira, is that these geopolitical events, when they happen, right? Market reacts very irrationally. So even if you're reasonably valued and something like this happens, you can go into the cheap zone. So in these kind of events, the ability of a balanced advantage fund or even a hybrid fund to kind of mitigate volatility is limited. So hence I say that, as an investor, you must work with some financial advisor or you must work on your own portfolio to clearly demarcate buckets and have funds which are specialists in those asset classes. So for example, if you demarcated your portfolio between debt, liquidity, growth, which is equity, and let's say insurance, a little bit of gold, then you must ensure that those allocations are proper. And rebalancing should happen once a year. That is my view.
Absolutely. Ashish, sorry, you wanted to add something?
No, or these kind of events give you the opportunity to rebalance.
Yeah, absolutely. Thanks very much, Ashish, for joining in. And Ashish has actually reminded us of, a very, very important saying that markets can remain, irrational longer than you can remain solvent. And I want to add also that, markets can even prove the majority opinion wrong. So do not try to take on the market. All we can do is, invest in researching our own asset allocation and sticking to it and rebalancing. It may be boring, but that's perhaps the only way out. Ashish, thank you very, very much for joining in. With that, we're going to take a very quick break. Up next, we'll be joined by Tarun Birani of TBNG Advisors, and he is going to present an investment guide for students. Stay tuned.